In 2011, I was sitting in our Oaktree conference room looking at an opportunity in European distressed debt. The numbers were compelling. The yields were extraordinary, 15% to 18% on investment-grade companies that had been marked down due to sovereign debt fears. My partners and I had the capital. We had the expertise. Every analytical model we ran said the same thing: deploy heavily. But I was 65 years old at the time. And I asked myself a question that changed how I thought about risk for the rest of my career. If I'm wrong, do I have time to recover? That question, that single moment of pause, led to a decision that made our investors hundreds of millions of dollars. Not because we avoided the opportunity. We didn't. We deployed $2.3 billion into European distressed debt between 2011 and 2013. But we did it differently than we would have at age 45. We structured it differently. We sized it differently. We thought about the timeline differently. The principle I discovered that day has nothing to do with being conservative or playing it safe. It has everything to do with understanding that the math of wealth building changes fundamentally after 60, not because you're old, not because you should be timid, but because the relationship between time, compounding, and recovery capacity shifts in ways that most financial advisors never acknowledge. Here's what I mean. At 35, if you lose 40% of your portfolio, you have 30 years for compounding to repair the damage. At 65, you might have 10 years before you need that capital. The recovery timeline isn't just shorter, it's exponentially more constrained, and that changes everything about how you should think about turning $200,000 into $2 million. Let me show you what this means for your money right now. Before I continue, I need to know who I'm talking to. Drop your age and current investable assets in the comments, not your net worth, your actual liquid investment capital. Be honest. This number determines which strategy I'm about to show you will work best for your situation. And if you're serious about building wealth after 60 without gambling your security, subscribe now. This channel isn't about hot tips or market timing. It's about second-level thinking. The kind of risk-aware, cycle-conscious approach that's protected and grown wealth through 8 market cycles since I started in this business. The professionals who manage billions use these principles. Now you will too. Here's what I'm going to show you in the next 12 minutes. First, why the conventional retirement advice you've been given is mathematically impossible for most people over 60. Second, the 5-phase framework that actually works when time is your constraint, not your advantage. And third, the specific allocation strategy we use at Oaktree for clients in exactly your situation. But you have to stay until the end, because the most important principle, the one that determines whether you succeed or fail, comes at the 9-minute mark. Let me start with what most people get wrong about building wealth after 60. They think it's about finding higher returns. They've been taught that if they just get 10% instead of 7% or 12% instead of 10%, they'll reach their goals. Every financial advisor shows them compound interest tables. Every retirement calculator asks for their expected return. But here's what 5 decades of managing money actually shows. After 60, it's not about the return you earn. It's about the return you keep. And more specifically, it's about the returns you don't lose. This isn't opinion. This is mathematics. Let me prove it to you. If you're 62 with $200,000 and you earn 8% annually with no significant drawdowns, you'll have $466,000 at 75, solid, respectable. But if you chase 12% returns and experience just one 35% drawdown, which happens in roughly half of all bull markets when they end, you need to earn 15% annually for the next 5 years just to get back to where the 8% steady strategy would have taken you. And you've lost 5 years you can't recover. The math is brutal. A 35% loss requires a 54% gain to break even. A 50% loss requires a 100% gain. At 65, you don't have the timeline to recover from a 50% loss. You just don't. Not without taking risks that could destroy you completely. This is what I mean by second-level thinking. First-level thinking says, I need higher returns to reach my goal. Second-level thinking asks, what's the probability I can achieve those returns without experiencing a drawdown that destroys my timeline? And it all comes down to something most people never consider. Sequence of returns risk. Not average returns, but the order in which you experience them. This is the principle that separates people who successfully build wealth after 60 from people who run out of money at 78. I'm going to break this down into 5 phases. Each one builds on the last. Miss one, and the system doesn't work. Master all five, and you'll understand how to turn $200,000 into $2 million, or whatever your target is, without betting your security on market timing or concentrated bets. Let's start with the phase that most people never learn, the foundation phase. This is where you are right now. You're 60 plus with $200,000. Maybe it's $150,000. Maybe it's $300,000. The specific number matters less than understanding what this capital represents. It's not your growth engine anymore. It's your security base. And everything you do from this point forward must start with one principle. Never put your security base at risk of permanent impairment. Here's what most people do. They look at their $200,000 and think, this isn't enough. I need to grow this aggressively. So they stay 80% in stocks. They chase high-growth tech companies. They buy into bull market narratives. It seems logical. It feels necessary. But it's wrong. And here's why. The math of loss is asymmetric. A 50% gain followed by a 50% loss doesn't leave you flat. It leaves you down 25%. The order matters. And when you're over 60, experiencing the loss first can destroy your ability to ever recover. Let me show you this principle in action. In 2007, I watched a 63-year-old executive, I'll call him Robert, retire with $850,000. He'd done everything right, saved consistently, lived below his means. His advisor had him in a standard 70-30 portfolio, 70% stocks, 30% bonds. Conventional wisdom, taught in every business school. Then 2008 happened. By March 2009, his portfolio was worth $430,000. He'd lost just over 50%. His advisor told him, "Don't panic. The market always recovers. You're diversified." All true statements. But here's what the advisor didn't tell him. Robert was 65 years old. He didn't have 30 years for recovery. He had maybe 10 years before he'd need to start drawing on that capital significantly. Robert panicked in March 2009 and sold 60% of his equity positions. Classic mistake. By 2013, when the market had recovered, his portfolio was worth $680,000. He'd recovered some, but he'd permanently impaired his capital base. At 69, he realized he'd never reach his goals. He had to dramatically reduce his lifestyle. Last I heard, he was working part-time at 76 because he couldn't afford not to, and this wasn't bad luck. This was a violation of the foundation principle. Never put your security base at risk of permanent impairment. At Oaktree, we learned this lesson in the 1990s. When we started our distressed debt business in 1988, right after the S&L crisis, we had investors in their 60s and 70s who wanted the returns but couldn't afford the volatility. So we structured our funds differently. We focused on senior secured debt. We prioritized capital preservation over maximum returns. We accepted 12% to 15% returns instead of chasing 25% returns with higher risk. Those investors, the ones who were 65 in 1988, many of them are still our clients today. Their children are our clients because we understood the foundation principle. At 65, your capital base isn't your growth engine. It's your security foundation. You can grow it, but only through strategies that minimize permanent impairment risk. Now, here's the second-level thinking. First-level thinking says, I need to be conservative, so I'll put everything in bonds and CDs. Second-level thinking asks, how do I build a foundation that protects against permanent loss while still maintaining purchasing power against inflation? And when you ask that question, you realize the answer isn't about being conservative or aggressive. It's about being strategic. It's about understanding that you need three things simultaneously: protection against market crashes, growth that exceeds inflation, and income you can depend on regardless of market conditions. This is what separates successful wealth building after 60 from failure. Not intelligence, not market timing, strategic architecture. So what do you actually do? You split your $200,000 into three buckets. Not equal buckets, strategic buckets based on timeline and purpose. Bucket 1 is your security bucket, 30% to 35% of your capital, $60,000 to $70,000. This goes into treasury bonds, TIPS, and high-grade corporate bonds with durations of 3 to 7 years. This bucket's job isn't to grow. It's to be there, guaranteed, when everything else is chaos. In 2008, while Robert was losing 50%, investors with proper security buckets slept at night. They had capital they could deploy when assets were cheap. They had options. Robert had panic. Bucket 2 is your income engine. 35% to 40% of your capital, $70,000 to $80,000. This goes into dividend aristocrats, REITs with strong balance sheets, preferred stocks of quality companies, and investment-grade corporate bonds with yields above 5%. This bucket's job is to generate $4,000 to $5,000 annually in income that you can reinvest during your 60s and early 70s. Not for spending, for compounding. This is your growth fuel. Bucket 3 is your growth allocation. 25% to 35% of your capital, $50,000 to $70,000. This goes into diversified equity positions, but not the way most people think. Not chasing momentum. Not buying whatever's hot. Instead, you're buying quality companies with sustainable competitive advantages, trading at reasonable valuations, in sectors that benefit from long-term demographic trends. And you're doing it systematically, not all at once. This isn't complicated, but it requires discipline. Most people can't resist the temptation to chase returns with their entire portfolio. That's why most people don't successfully build wealth after 60. You can start this today. Open your brokerage account. Look at your current allocation. If it doesn't match this structure, begin the transition, not tomorrow, today. But this structure alone isn't enough because markets don't move in straight lines. Which brings us to the second phase, the accumulation phase. This is years 1 through 5 of your strategy. Roughly ages 60 to 65 or 65 to 70, depending on when you start. During this phase, your job isn't to get rich. It's to systematically build your capital base while maintaining your security foundation. Think of it like building a fortress. You don't build the walls and the interior simultaneously. You build the walls first. Then you build inside the protection. Here's what most people do during this phase. They watch the market. When it's up, they feel good. When it's down, they feel anxious. They make decisions based on emotions. They chase performance. They sell after losses. Classic first-level thinking. But here's what the data shows. The investors who successfully build wealth after 60 do the opposite. They ignore short-term market movements. They focus on systematic capital deployment. They buy when others are fearful. They rebalance mechanically. And most importantly, they understand that volatility isn't risk. Permanent capital loss is risk. Let me show you this principle in action. In 2020, when COVID crashed the markets in March, we had a client, I'll call her Margaret, who was 67 with $280,000. She'd been following this exact framework for 3 years. When the market dropped 34% in 23 days, her portfolio dropped only 18% because of her security bucket. But here's what made the difference. She had $85,000 in her security bucket that wasn't affected. She had $12,000 in dividend income that had accumulated over 3 years. And she had the discipline to deploy $40,000 from her security bucket into her growth allocation when the S&P 500 was down 30%. By December 2020, her portfolio had not only recovered, it was up 23% from the pre-COVID peak. Not because she was smart, not because she predicted anything, because she understood the accumulation principle. Systematic deployment of capital during periods of market stress is how you accelerate wealth building when time is constrained. At Oaktree, we deployed $11 billion in 2008 and 2009, not because we predicted the recovery, we didn't. But because we had capital ready, we understood cycle positioning, and we knew that the best opportunities come when everyone else is paralyzed by fear. Our investors who were 65 in 2008, the ones who stayed disciplined, saw their capital grow by 180% over the next 6 years. The ones who panicked and sold never recovered. Now here's the second-level insight. First-level thinking says, market crashes are scary, I should avoid them. Second-level thinking asks, how do I position my portfolio so that market crashes become opportunities rather than disasters? And when you ask that question, you realize the answer is about liquidity and courage. You need liquid capital that isn't at risk, and you need the emotional discipline to deploy it when prices are attractive. This is what separates wealth builders from wealth preservers. So what do you actually do during this phase? You follow a systematic rebalancing protocol. Every quarter, you review your 3 buckets. If your growth bucket has grown beyond 35% of your portfolio, you take profits and move them to your security bucket. If your growth bucket has fallen below 25%, you deploy capital from your security bucket to buy at lower prices. This isn't market timing. It's mechanical discipline. You also reinvest every dollar of dividend and interest income back into your growth bucket during this phase. You're not spending yet, you're compounding. A 4% yield on $80,000 is $3,200 annually. Over 5 years, that's $16,000 plus growth. Reinvested systematically, this becomes $22,000 to $28,000 depending on market conditions. This is how you accelerate without taking excessive risk. And you track 3 metrics quarterly: your total portfolio value, your security bucket as a percentage of total assets, and your annual income generation. If your security bucket falls below 25% of assets, you stop buying growth assets and rebuild security. If your income generation falls below 3.5% of your portfolio, you adjust your income bucket allocation. These metrics keep you disciplined when emotions say otherwise. This isn't sexy, this isn't exciting, but it works. And working is better than exciting when you're 60 plus with $200,000 and a goal of $2 million. But the accumulation phase is just the beginning. Because between years 5 and 10, roughly ages 65 to 75 or 70 to 80, something changes. Your portfolio has grown. Maybe it's $400,000 now. Maybe it's $550,000. And you face a new challenge. How do you continue growing while beginning to generate income you might need? This is the transition phase, and it's where most people make their fatal mistake. They start spending from their growth bucket. They see their portfolio at $450,000 and think, I can afford to take $30,000 a year now. They reduce their equity allocation to 40% because they're getting older. They follow conventional wisdom about age-based allocation formulas, and they guarantee they'll never reach $2 million. Here's why. The transition phase is when compounding accelerates. You've built your foundation. You've accumulated capital. Now you have critical mass. But only if you don't interrupt the compounding by spending from growth assets. The math is unforgiving. A $450,000 portfolio growing at 7% becomes $891,000 in 10 years. The same portfolio with $30,000 annual withdrawals becomes $587,000. You've cut your terminal value by 34% by spending too early. This is the principle that took me decades to fully understand. The transition phase isn't about transitioning to spending. It's about transitioning to spending from the right sources. Your income bucket should be generating $18,000 to $25,000 annually by this point. If you need income, you spend that. Your growth bucket continues compounding untouched. This is how you build toward $2 million while maintaining your lifestyle. Let me be specific about implementation. By year 5, your income bucket should represent 40% to 45% of your portfolio. That's $180,000 to $250,000 if you've grown to $450,000. This bucket should be generating 4.5% to 5.5% in yield, $8,100 to $13,750 annually. Add Social Security, and most people can cover basic expenses without touching growth assets. If you need more, you take it from your security bucket, not your growth bucket. This preserves the compounding engine. And here's what concerns me. I'm seeing retirees right now making the exact opposite mistake. They're watching their portfolios grow and immediately increasing spending. They're buying second homes, taking expensive vacations, helping adult children financially. All understandable, all potentially fatal to long-term wealth building. Because once you interrupt compounding in your 60s and 70s, you can't restart it. The timeline is too short. This is second-level thinking. This is cycle awareness. This is risk management. This is what keeps you wealthy through decades, not just years. Not conventional wisdom. Not age-based formulas. Strategic discipline based on understanding how compounding actually works when time is limited. The ultimate insight is this: turning $200,000 into $2 million after 60 isn't about finding the perfect investment or timing the market. It's about understanding that wealth building at this stage is about architecture, not alchemy. It's about building a system that protects your foundation, generates income, and allows growth to compound without interruption. It's about having the discipline to follow the system when emotions say otherwise. So how do you actually implement this? Let me give you the specific framework I've developed over 50 years that survived every crisis since 1974. Before every major financial decision, ask yourself these 5 questions. First, does this decision protect my security bucket or put it at risk? If it puts it at risk, don't proceed. Second, does this decision generate sustainable income or chase capital gains? Prioritize income. Third, does this decision allow my growth bucket to compound or interrupt it? Preserve compounding. Fourth, am I making this decision based on fear or greed or based on my systematic framework? Follow the framework. Fifth, if this decision is wrong, do I have time to recover? If the answer is no, reduce position size. If you can't answer these questions with confidence, don't proceed. This isn't about being timid, it's about being strategic. Now, here's what you need to do in the next 48 hours. First, calculate your current allocation across security, income, and growth buckets. Write down the actual numbers. Second, calculate your current annual income generation from dividends and interest. Write down that number. Third, determine if your security bucket is adequate. It should be 30% to 35% of your total portfolio. If it's not, begin building it immediately. And here's what you need to track going forward. Your security bucket percentage quarterly. If it falls below 25%, you're taking too much risk. Your annual income generation. If it's below 3.5% of your portfolio, you need to adjust your income bucket, your total portfolio value annually. Not to celebrate or panic, but to know where you stand in your journey to your goal. This isn't sexy, this isn't exciting, but it works. And working is better than exciting when your financial security is at stake. That $200,000 we started with, that's where we began. Now you understand it's not about that specific number. It's about the system you build around whatever capital you have. Turning $200,000 into $2 million after 60 isn't about magic. It's about mathematics, discipline, and understanding that risk management is more important than return maximization when time is your constraint. I've spent 5 decades learning this. I've made mistakes. I've watched brilliant people destroy themselves by chasing returns. I've watched disciplined people build extraordinary wealth by following principles, and I've distilled it down to this framework. You now know what took me 50 years to learn. You have the advantage of this knowledge. The question is, will you use it? Because here's the reality. Most people will read this, nod along, and change nothing. They'll go back to checking their portfolio daily. They'll chase the next hot stock. They'll make decisions based on fear when markets drop and greed when markets rise. They'll get the same results everyone else gets. Don't be most people. Before you go to bed tonight, open your brokerage account and calculate your current 3-bucket allocation. Write it down. If it doesn't match the framework, 30 to 35% security, 35 to 40% income, 25 to 35% growth. Write down specifically what you need to change. That's your first step. Not planning to do it, actually doing it. And subscribe if you haven't already. Because this channel is about thinking like institutional investors who manage billions, not retail investors who chase tips. This is about understanding that wealth building after 60 is possible, but only with the right framework. Market cycles are inevitable. Risk is always present. What's uncertain is how you'll respond when the next crisis comes, and it will come. Having a framework means you'll respond with discipline instead of emotion. That's the difference between reaching $2 million and running out of money at 78. That's what 5 decades of investing teaches you. That's what surviving 8 market cycles shows you. That's what managing billions through multiple crises proves. Turning $200,000 into $2 million after 60 is possible. But only if you understand that it's not about the returns you earn. It's about the returns you keep and the compounding you protect. I can't do it for you. I can only show you how. The rest is up to you.